So the Fed's steps to address the Silicon Valley Bank collapse and its fallout are a great example of the problems that I talk about in my book, The Fed Unbound, that have arisen in the last decade and a half in the US banking system. Now, the main focus of the book is shadow banking, the existence of deposit alternatives issued by non-banks that aren't even subject to any FDIC insurance or ongoing Fed or FDIC oversight. But one of the things that the rise of shadow banks has done is put pressure on banks and led to greater risk-taking in banks and greater fragility in the system overall. And so the Fed's need to intervene over the weekend is indicative of the great sensitivity of the system to any instability, any type of run dynamic, because there is so much runnable money, not just in the banking system, which is 43% uninsured deposits, but outside of the banking system, which has trillions of dollars of runnable deposit alternatives that are also uninsured. And against that backdrop, you have a Fed that has to go to extreme lengths and act on a trigger to prevent a conflagration like we saw in 2008, and we also saw in 2020, where for a week or two the whole system was melting down, shocking even the most seasoned experts, and giving rise to a massive response. And it's that mindset that was still at work this weekend, where Fed officials knew the lesson from 2008 and knew the lesson from 2020, which is overwhelming backstopping for this system is required right at the beginning if you want to avoid a recession. Part of what I say in my book is this is a terrible way to organize an economy because the public, the central bank, is more or less at the mercy of an unstable financial system. So the actors in the system take risks, make profits, and then the central bank reacts by providing massive support. And we need to break that cycle. And the Fed can't itself really break that cycle. Congress needs to intervene and restructure the system before we end up in a Great Depression